joining today for the webinar on how to invest in government bonds. Given the uncertain economic environment and fear of recession looming around, it is important to move our life savings to safe haven like government securities. They have minimum risk as they are issued by the Government of India. Retail investors until a few months back were, however, not allowed to invest in government securities. A retail direct scheme was launched by the Prime Minister on 12th November 2021. The scheme was announced by RBI in its monetary policy of February 2021. Now, Retail Direct Scheme is a one-stop solution to facilitate investment in government securities by individual investors like me and you. The objective of the scheme is to provide safe, secure, and direct platform to investors to deal in government securities. We are honored to have Mr. Biju Karnath from CCIL to help us understand how to invest in government bonds using RBI Retail Direct Scheme. Thank you so much, Biju sir, for accepting our invitation. The stage is all yours. Thank you.
Thank you, Aishwarya. I mean, that was a good introduction. Yes, government securities, probably if you read about government securities for the last 3-4 months, it has been in the news. I know most of the investment advisors are now advising people to invest in government securities. Okay, so just before we start, I will set the agenda for the day for the next 1 hour. So probably government securities. Once I don't know, most of you would have heard about it, but never have looked deep into what this asset class is all about. People would have heard about equity, commodities, probably crypto also, but government securities has always been at the backside and out of the limelight as far as the investment avenues are concerned. But probably what I'll do is going by our experience of the last 20 years working with RBI to implement many reforms for the government securities market, probably including RBI Retail Direct. We will try to just tell you more about this asset class and give you more insights into this asset class, and probably leave it to you to probably think about how you can further invest into this market. Okay, so the agenda for the day would be like I would be describing the government securities market, then probably just to discuss something about the returns that presently you can earn on the government securities market, and then followed by the RBI Retail Direct Scheme. So is the screen moving from my side in terms of the presentation?
No, sir, it's not. We're still in the starting slide.
Okay. Yeah. So this is the agenda. We'll just describe this government securities market as it is today in terms of participation and the outstanding issue size. Then we will just compare the returns from the government securities market just to give a highlight of what you can actually earn from the government securities. And then we will talk about the RBI Retail Direct Scheme. Okay, so this is the market. If you look at the outstanding issue size of government securities, when we talk about the issuance by the central government, so we have issuances by done by the central government of India, and then we also have issuances done by each and every state. So if you just look at the outstanding issue size of the central government, is approximately $1 trillion, which makes us the third largest in Asia. After China and Japan, we are the third largest market. And if you add on to the state government borrowings also, it's about 1.5 trillion. Okay, so that is a huge market we are talking about in terms of the outstanding issue size. Similarly, if you look at the tenor profile, you have investments right from 91 days to up to 40 years. So that kind of entire maturity spectrum is available to you to invest in the government securities market. If you look at other asset classes, probably the maturity profile gets it's not so long. So here you can go right up to 40 years. Participants, obviously major participants are banks, mutual funds, insurance companies, and foreign portfolio investors, and then recently individuals also. Okay, the average volume, and I'm talking about one side volume, which is about 35,000 crores to 40,000 crores on a daily basis in this market. So this is the size of the market. And if you look at the infrastructure, so no, probably the only thing that needs to be discussed as far as the asset class is concerned, what is the current infrastructure available for the market? Okay, so if you look at it, RBI is the regulator for this market, and RBI has taken a lot of steps over the last 15-20 years to ensure that this market is safe and you have a robust infrastructure in place for investing in government securities, because infrastructure gives you that confidence that everything is in place. And probably the genesis of this infrastructure goes back to the 1992 scam. You would have heard about that 1992 scam in the government securities market, which led RBI to come out with a series of reforms in the government securities market. And now we are at a place where the infrastructure for the government securities market is world class. I mean, we are one of the few countries which has all the right nodes in the infrastructure in place. So RBI is a debt manager, so they conduct all the primary issuances. You don't have to actually go to any other intermediary. You can directly go to RBI to participate in the primary issuances. RBI is also the depository. So just like you have NSDL and CSDL for the equity market, RBI is the electronic depository for the government securities market, and it's offered free of cost to each and every one. And there is an electronic trading platform now available. So from 2005, we have this anonymous dealing system called NDA Zone, where most of the institutional participation happens. So you have the banks, primary dealers, insurance companies, or everybody investing and trading on this electronic platform. And this is without any intermediary. So you can directly trade on this platform without going through an intermediary. So that is the biggest advantage of this platform. And this platform is actually owned by RBI. So you don't have any other conflict of interest issues. Retail investors are now given access to this platform, and you actually access this platform directly without any intermediary. So that is a huge thing. CCIL, talking about CCIL, CCIL is the term is central counterparty. So basically, essentially what we do is we guarantee all trades in the government securities market. So, just taking this analogy from the equity market, if you're trading, if you're buying some shares, you never know who's the buyer or who's the seller. But at the end of the day, finally the funds or the securities gets credited to your account, maybe T+2. Here, CCL does the same role for the government securities market. Once you trade the government securities, you ensure that you get your funds or your securities. So that infrastructure is also in place. T+1 rolling settlement. So here we follow a T+1 settlement. Basically, if you trade today, you get your money or the securities tomorrow morning. And DVP3, basically, if you buy and sell, we net it out. So that is it. And we have a market maker scheme on the government securities. So you have a specific entity type called primary dealers recognized by the RBI, who actually make markets in the government securities. So they give you constant two-way quotes, and you can actually trade in the secondary market for this thing. So if you look at the infrastructure, by 2005 we had all the possible infrastructure in place to make it a very good market. And this was before the 2008 financial crisis. So we were well placed when the financial crisis happened, because all this infrastructure was in place. And RBI had a very good control over the entire government securities market. Why I'm telling you is basically to give you that confidence that this market, unlike any other market, is not sort of a unregulated kind of thing. It is a properly regulated market. There are institutions in place, institutional structures in place, which actually gives you that confidence that when you invest your money here, the backend takes care of the entire thing. In fact, just to share with you, after 2005 and after the 2008 crisis, you had actually people from other countries coming and studying our system so that they could replicate the entire infrastructure there. So that is it, how it is. Now, just talking about the holding pattern, I'm just trying to build a case for retail investment. So if you currently look at the holding pattern, commercial banks have about 38%, insurance companies about 26%, and RBI is also a major holder. But if you look at the retail investment in government securities, presently it is less than 1%. Okay, presently it is less than 1%. Probably the only missing piece was an infrastructure for the retail. So you had the institutional infrastructure in place quite early on from 2005. The retail infrastructure and ecosystem was RBI was trying for quite some time to build this, but probably RBI direct scheme is the answer to that. Maybe with this infrastructure in place, probably you have more retail coming in. So if you look at the holding pattern, retail is less than 1%. Probably, if you look at the other developed countries also, no, retail is not very much. Why? Answer is retail probably participates to the mutual fund industry. Overseas also it's the same case, but you have some exceptions. For example, US, the retail investment is about 5%. And I think in Korea and Philippines, probably you have 10% of retail investment because they have got specific bonds dedicated to retail investors. Maybe India will also go and experiment later on that, but that is the probably exceptions. But the more general rule is that retail normally prefers to go through the mutual fund industry. Then coming to the point why you should invest in government securities. I think I should just give the introduction. You want to look at a stable and assured returns. There is a recession that's going to take place. You want to move your assets to a safer place and all those things. Fine, that is definitely there. And plus, as you said, there is no default risk. The issuer is the sovereign, right? A sovereign ideally is say that they cannot default because they can print money, they can impose taxes. So ideally, if you look at from the risk ladder, that stands at the bottom because you hardly have any risk of default happening. Even in case of a fixed deposit, you have a risk. I mean, people don't understand that, but your fixed deposit is only insured up to 5 lakhs. If you look at the actual terms and conditions, your fixed deposit in case of a bank default is insured only up to 5 lakhs. You are only insured, you only get your 5 lakhs back. The remaining you will have to actually wait for the liquidation to take place. So compared to even FD, this government security in terms of a default risk is zero. So that's how it is. Infrastructure I've already talked about. You have a very transparent primary market. You have a very deep secondary market. For the retail infrastructure is also has been built, and because it is all by RBI, the transaction costs are virtually zero. I would say you hardly have any holding cost in your demat account. I mean, with RBI, you hardly have any primary participation cost. You hardly have any secondary multiplication. Most important thing is the diversification feature. So in case you want to diversify, so you have equity, you have gold, you have got your mutual funds, you probably have your crypto also. But and if you have an FD, one more asset class you can diversify is your government securities. There are fixed income instruments. I mean, you have corporate FDs, you have the national savings schemes, you have the PPF. No, those things are there. But assuming that you still have some surplus money which you would like to deploy, then that is the biggest advantage. You have a very deep market here where you can deploy your money. There are, I mean, this is just a in case you want to exit, you can exit without any penalties. I mean, there is no premature redemption penalty unlike an FD where you want to do this. So that was the introduction to the government securities part of it. Okay, now we come to the returns part of it. So no, this is a use. I mean, this is the only case why right now it's the right time to invest in government securities. So we have just taken a snapshot of the GSEC rate as of yesterday and the FD rates as of yesterday from a top bank. And if you see the rates, so no, as I told you, the government security tenor is available from 91 days to up to 40 years, and we have just listed down the secondary market yields for all the GSEC as of yesterday and the FD rates. And you look at the difference, what is it? And both are fixed income. I mean, you get the same return from an FD, you get the same return from a GSEC. Forget the default risk and all those things. But you just look at the return. 91-day T-bill. 91-day T-bill. If you invest today and you get a 91-day T-bill, you're actually getting 200 basis points more than an FD. I mean, who does not like money? So this is the only feature that is it, and this is trend we have been observing that where for the last 3 years the FD rate has been going down and it is actually below the risk-free rate. Ideally, a FD rate should be above the risk-free rate, but due to structural issues in the Indian economy and not only Indian economy, even the global economy, you have witnessed it over the last 3 years where investors are actually being given a pittance as far as the FD rates are concerned, and so this alternative becomes very attractive for you. You just look at the 10-year rate. I mean, above 15, 30 and 40, no fixed deposit is available. But if you look at the 10-year rate, still you are earning 145 basis points more than of FD. So, I mean, this is the actual use case for that GSEC and making it very attractive today. We just compare the FD rates. So if you look at the 3-year, it is below the GSEC rate. If you look at the 5-year, it is below the FD rate. And if you look at the 10-year also, it's below the FD rate. So has been the trend right from pre-COVID also. So during COVID, obviously the government pumped in a lot of money into the economy and banks were flushed with cash. But this trend we have been noticing quite some time. And what we expect is, given the bias towards growth vis-a-vis anything else, you will see that banks will always be offering less returns on their FD vis-a-vis the other market avenues. And that is why you see the mutual fund subscriptions going up. People slowly going the chase for yields. People are slowly moving to other risky assets like options, futures, crypto, etc., etc. But FD is definitely, vis-a-vis an FD, this is definitely a very good option as far as investing concerned. Just like to share, there was another report yesterday, I think it was in the Financial Express, where it was mentioned that around 370 billion, USD 370 billion has moved from the banking industry to other revenues. And there also, there's the same problem in the US, where your treasury rates are more than the FD rates. Your government security rates are more than the FD rates. And again, that's the same problem, because central banks have pumped in a lot of money into the economy to boost growth. You have the cases where the banks are actually offering you less money. In fact, 2-3 years back, they were offering negative interest rates on fixed deposits. India may probably reach that stage in 20 years, but not now. So this is the case for the government securities. So the second point was about the returns, I think, and then we come to the scheme act per se. So the first statistics showed you that more or less we were an institutional market. The retail participation was always through the mutual fund industry. Direct participation of retail in the system was actually it was there, but RBI was trying through various other avenues. I think 2003 they allowed the exchanges, stock exchanges to trade, do retail trading in government securities, but never picked up, because obviously if you're going through an intermediary, they are more interested in getting the equity and the other asset classes rather than a government security, where the volatility is less. It's stable, and obviously the as compared to equity, the returns are not so great. So exchange scheme was there in 2003, but it didn't work. Then I think they also tried to the banking sector to promote this government securities. But banks, as you know, it's a conflict of interest because it cannibalizes their fixed deposits. So they were also not interested in promoting this. And then finally, RBI came out with a scheme where individual investors, if you look at RBI, they never directly talk to a retail investor. But now through this scheme, they actually talk to directly to a retail investor. And this retail direct scheme is modeled on the US Treasury Direct scheme. So if you go to the US site, US Treasury has got a site called US Treasury Direct. There, the same concept where retail investors can directly invest in government securities with the central bank. So there the Fed is there, and you directly invest in the government securities using the Treasury Direct. More or less, the scheme is the same. You are not directly talking to the Reserve Bank, and you can invest in the government securities bonds through this scheme. So just talking about this scheme, it's a very simple thing. It's a completely digital. There is no physical thing involved here. So you just come to the portal, and it's a one-stop solution. That's the word that we use. So once you register and you open an account, you can directly participate in primary auctions. You can trade in secondary market, and it's a 24/7 portal available. Portal is available. So once you open this account with RBI, it's called the Retail Direct Gilt account. It's called a gilt account because the government security account is called a gilt account with RBI. Okay, once you open this gilt account, you are eligible to participate in the primary auctions. You can, using the same login, you can actually go and trade in the secondary market in case you want to trade in secondary market. And it's 24/7 available. The primary auction and opening of account portal is available 24/7. So you can actually bid, on a Saturday, Sunday, whenever you have the time, looking at the details and everything. If you go to the website, you will the website is RBI Retail Direct. We will just share the website link later on. So if you go to there, you will find all the current interest rates in the market, the secondary market rates for the government bonds, and the auction announcement. So every week, RBI comes out with an auction. State government auctions are there, treasury bill auctions are there. You also have auctions for central government. So all the schedule of auctions, what are the securities that are being auctioned, how to bid in that. There are tours available, there are videos available. So all the helps that you want in terms of investing in government securities is available. FAQs are there. It's currently available in English and Hindi. Probably we will have a multi-language, FAQs also going ahead on this. So just to coming back to the RBI retail, in case you are interested and you want to open an account, you go to the website and it's completely digital onboarding. So you just have to fill in your name and PAN and email and mobile. The email and mobile gets authenticated with an OTP, and using the PAN, we actually hit the central KYC database. In case you are registered there, we get all your details and your account gets opened. So there is nothing else you need to do. In case you are not registered with the central KYC, you will have to do a video KYC. So all those links ups are already built in, and so it hardly takes about 5 minutes. In case you are a central KYC registered investor, it hardly takes 5 minutes to open an account. In case you're not registered with CERSAI, then you have to go through a video KYC process, which takes about all in all it takes about 8 to 12 minutes to open an account. So these are the steps. It's completely digital. I mean, it's available on the portal, and you don't have to visit any physical sites. The bidding in the primary market, once the account gets opened, once your KYC is verified and you get the user ID and login, and your account is also opened, then you have to actually track the auctions. So you get SMS alerts. In fact, you get email alerts for every auction that is announced by RBI, along with the details. What is the current auction available, which states are auctioning, or which is the security, central government security, which is under auction. You can take your decision whether you want to bid in a 91-day T-bill or a 364-day T-bill or a 5-year bond or a 10-year bond or a 40-year bond. I mean, you get all the details, you take your decisions. Okay, and remember here the bidding is non-competitive. Now I just explained this non-competitive bidding a bit. So normally when an auction is considered, there is a competitive portion and there is a non-competitive portion. So the competitive portion is open to banks, PDs, mutual funds. So they determine the price in the auction based on the demand supply, whatever that price gets determined, and the retail investor in the non-competitive bidding gets the weighted average price of all these bids in the non-competitive bidding. So ideally the retail investor need not be worried about the pricing and all those things. The price gets determined by the actual institutional investor. The same price gets passed on to the retail investor. So you just have to put in the amount. The price is given by Reserve Bank of India. The indicative yields are already shown to you in the platform, and the indicative yields and actual yields that you get would be plus minus that indicative yield that you would be seeing. Additionally, you can invest in sovereign gold bonds. So sovereign gold bonds, normally you have other revenues to invest, but here on this portal you also get to invest in sovereign gold bonds. So that is how it is. Maybe in a 3-4 months you will also see another bond called that savings bond. So if you have heard about that bond, RBI savings bond, where you are getting currently about 7.15 as rate of interest, that also will be available on this platform. Okay, once you do the bid, you have to fund it. You can fund it through UPI or net banking. We are linked to a couple of payment gateways. It's online. You just make the payment, and once you make the payment, you get a confirmation that the payment is accepted and cited. And on the auction day, the auction happens, and the allotment and details are sent to you by SMS and email. You get your holdings. I mean, the moment the auction is done and the allotment is done, you can actually see your holdings. What are the holdings? What is the government securities you are holding, and you can track your. So a government security pays interest every 6 months, and finally you have a redemption also. So every 6 months, what is the interest that is due to you, and all those things you can hold it. So this is as far as the primary market is concerned. So you just have to. I mean, it just takes about a minute to place a bid. The auctions watch is available. You just go to the auction watch, select that auction, place a bid. And you can go as low as 10,000. The minimum is 10,000 rupees. The maximum is 2 crores. So it's a completely RBI has made it right up to the lowest level where you can actually bid for 10,000 rupees in case you want. And we have seen many investors starting with 10,000, trying to understand the system, and then slowly increasing their bid amount. And now we have seen people even bidding the max also. So this is the maximum you can bid is 2 crores. The minimum is 10,000 rupees, and you don't have to worry about the price. You just put the amount, make the payment, and everything else is done by the system on the auction day. You get all the details here, and then you can just the payment is through net banking and UPI. So net banking gives you a higher limit. UPI you have a limit of 2 lakhs right now. Then comes the secondary market part of it. So there are three portions. One is the digital onboarding, that is you open an account using that KYC portal. Then you can actually participate in the primary market and just stop at that, and then you are happy with the investment and you can hold it in maturity. In case you want to exit or you want to actually trade in this government securities market, and government security trading is, I mean, there are times when it is as remunerative as an equity market, and there are times when government security returns have been much more than the equity markets. It depends on at what time you are trying to enter the market. So in case you are interested in trading or exiting your investment, you can take access to the secondary market system also. So the secondary market system is free. You just have to indicate your interest for the secondary market, and you get a login ID. And then in case it's the same process. So in case you want to sell, automatically all your holdings are available for sale. You can just exit your this thing. And RBI is actually the primary dealer system that we spoke about. So there are market makers on NDOSOM who will actually give you quotes. So you can come to the system, seek a quote or put an order, and you will definitely get a counter quote from a primary dealer on that. So that way RBI is trying to ensure that there is also a secondary market liquidity for all the investors who are coming into the retail direct system. So that is there. So your holdings in retail direct are directly available for sale. In case you want to buy something, so not every security is auction. We have got about 130 securities. So RBI comes out selectively with 4545 securities per auction. In case you want to have some other security which is not part of the auction, you can actually buy in the secondary market. Yields more or less would be the same. So what you can do, you can fund your you can fund the system through a net banking or a UPI. You get a limit. Let's say you have funded 5 lakhs, you get a 5 lakh limit. Using that 5 lakh, you can actually buy, and T+1 the security will get credited to your account. So that also we have seen people actually going and buying in the secondary market, because they sometimes see some arbitrage, will not wait for the primary auction, directly go to the secondary market and buy the security. Okay, so the moment you buy, your holding automatically gets updated, and the holdings is a addition of your primary plus your secondary market holdings. So that is your NDOSOM system. And more importantly, you are accessing the same liquidity pool which the bankers or the banks, mutual funds, and insurance companies are using. Okay, and you also get the advantage of a primary market, primary dealer making a two-way to you. Other facilities on the retail direct portal, you get an account statement. You can give a nomination facility. You can gift. Government securities are eligible for gift. Coupon payments and redemption payments come to your account directly. The registered account, you have to register a bank account with us, and on every 6 months, your eligible coupons will get credited to your account, and you will get a SMS alert for that. For redemption also, redemption automatically gets credited to your account, and you will get an SMS alert for that. This is our website. You can actually go through the FAQs, and the tours are very very interesting. We have tried to explain the government security, the risks in investing in a government security, and all those things. And you can actually go through the FAQs in all those websites. So the potential, I mean, before we started this entire exercise of creating a portal, a scheme kind of thing for retail investors, we just had an analysis of what is actually what actually is. So India, fortunately, we have a large population which looks for stable returns, I would say, and they a lot of pensioners, people retiring, nearing retirements, or retired people, they actually want this thing. Unlike other countries where people are more risk, I mean, they would like to take more risk. In India presently, the structure is like that, where we see people really requiring yields, and the last 3 years have been very, very bad for these investors. So if you look at the population in the age group of greater than 50, it's about 20%. You look at the financial literacy in that age group, it is more than 25%. So you have a very good base which is available for investment in government securities. The interesting factor is this fixed deposits. So the fixed deposit with the banking sector is about 151 trillion. So even if 1% or 2% comes to a government security, this thing, that's huge. We are talking about huge money that is ready for coming in, and this money slowly is going into riskier asset classes like crypto or options, futures, and all those things. So people who are looking for stable returns, and and the interest structure right now is such that you actually get better returns than an FD. So you can actually think of shifting 20% of your FD portfolio. Keep aside your equity and all those investments. But if you have some FD, you can actually take 20-30% of your FD and put it into a government security. That is the investment strategy that normally we recommend to people. And if you look at the fixed deposit ka breakup, so metros are more than 50%. So you have a very good population, educated population, access to internet, or all those things available, who can actually put it into a government security. And if you look at the FD less than 1 year, so if you remember the rates that we showed you, it's 200 basis points more than an FD less than 1 year, and 14% is greater than 5 years. So if you look at that maturity spectrum also, you have a huge pickup in terms of yield that you get when you invest in a government security vis-a-vis a fixed deposit. So we're just talking about the fixed deposit market. We're not even talking about other markets like mutual funds. So this fixed deposit is probably 5 or 6 times more than the mutual fund market. Maybe I don't know how many times more than the equity market. So that is what we're trying to take it. And if you look at the present higher rates, you lock into a government security. Assuming that the fixed rates goes up tomorrow, you can actually exit a government security without any premature penalty, and you can actually come back to an FD. So you have an arbitrage which plays out by locking into a higher rate right now, and assuming that banks actually, because of some reduction in systemic liquidity or something, to actually raise rates, you can exit the government security and lock into an FD rate. But when you try to do the reverse, it is not possible because you are stuck with you are hit with a premature penalty. So that is one thing that you should understand. And the maturity ladder strategy. So assuming that there is a liquidity risk, so the biggest risk about the government security is not the credit risk, because the sovereign will not default. The money will come back to you always. But when I want it, I will not be able to exit the investment. So that is one risk that normally gets talked about government security. So I have bought a security maybe 6 months earlier, and now today I want to exit that. So I may not immediately get a buyer for that. So RBI is trying to make markets through PDs, but assuming you are not able to exit a security, you are faced with a liquidity risk. I mean, you want money and you are not able to exit. So that is the only risk in a government security. And in case, and there are ways to manage that risk. The management is through something called a maturity ladder. So you invest some portion in 91 days, some portion in 182 days, some portion in 364 day T-bill, some portion in 2 years, some portion in 5 years, some portion in 10 years. So it keeps on rolling on. So in case you want the money comes back. Obviously, your returns may not be gets a bit lower, but you manage the liquidity risk at a cost. So that is what we advise people. Okay, you follow a maturity ladder strategy rather than just putting all your money in a 30-year. A 30-year bond today gives you 7.5. I mean, it's so exciting, so interesting to get 7.5 when the deposit rate is 565. But then you are stuck with a liquidity risk. So don't put all your money in a 30-year bond or a 40-year bond. 20% goes to 30-year, 40-year. 20% goes to a 91-day T-bill, so that you can manage your liquidity risk. You can also invest in bonds. I mean, floating rate savings bond is nothing but the RBI savings bond. So that bond will be soon available on retail direct. And in the secondary market, there is a bond called, it's a derivative of the bonds called strips. It's a bond gets stripped into its constituents like a coupon and principal, and then it's available at deep discount. So let us say you are trying to buy a 10-year strip. So you actually pay 50 rupees now and you get 100 rupees after 10 years. So it's like a very deep discount bond that is available in the secondary market. So this is not available in the primary market. You have to go to the secondary market to buy this kind of bond. So you have a specific purpose investment that you want. So you want to lock in a 10-year for some education purpose, or a 20-year for something. You can actually buy a 10-year strip. You have to pay 50 rupees here and you get, and the yield that you get is normally what you would get in a normal 10-year bond, or maybe even slightly more than that, because it does not give you intervening cash flows. So this is the potential that we see, and we know that since the infra has been just put in place last 6 months back, we expect that slowly it will pick up, and there will be more awareness. I mean, the only issue is awareness. As we spread more awareness of this scheme among the population, you will have more and more people joining this, and it will be a win-win for everybody. The performance so far, I mean, this is the performance. So we launched on November 12, 21. Until August 31, we have already got, I mean, we have already crossed 1 lakh registrations. Okay, and we have already crossed 500 plus crores of holding in all these bonds put together. So central government people have invested about, I think it would have crossed 200 crores now. SG maybe 100 crores. and treasury bills would have crossed 200 crores again. Sovereign gold bond, that is SGB, around 86 kg people have invested through retail direct scheme. Secondary market trading, surprisingly, we thought people will not trade. People now, we always have this impression GSEC is complex and no, it's not for us. We don't understand this asset class. We don't know why the yield moves up and down and all those things. But I mean, simple buy low, sell high. Everybody understands that. So we have seen people coming to the secondary market, buying bonds, which, so a 10-year bond, you could have multiple bonds in a 10-year segment. So you have the most liquid bond, which is going at probably 720, but you could have a slightly liquid bond, which may be going at 724. So you just buy that. For you, you are a retail investor, you're going to hold till maturity, you have earned 4 basis points more than this thing. So there are people who have understood this market. There are people who are trading in the secondary market also, which is heartening to know, because the impression was always that government securities are complex. It's not so. It's very simple. Once you open an account and start bidding in the primary market and trading in the secondary market, you will understand the dynamics of it. This is it as far as I am concerned. In case I think we can stop at this, and in case you have any questions, I would be glad to happy to answer those questions.
Thank you very much, Biju sir, for this talk. I think many of us were not aware of how to invest in government securities, and this talk kind of helped us how to do it. So if anyone of you have any questions, then you can please leave your question in the chat box, and I will pass it on to the speaker. Any questions? Okay. So one person is asking, what is the minimum deposit for trading? So I think that is 10,000. Is that right, sir?
Yeah, the minimum lot size for trading is 10,000. So you will have to fund it for 10,000 and then you have to start trading.
All right. So what are the transaction charges?
Yeah, so that's it. So it's a completely free scheme. So even if you for primary market participation, it's free. And even for trading in the secondary market, there is no cost.
Okay, so whatever returns that we get out of the investment, what exactly happens to the tax to that gains that we make?
Yeah, as far as the government securities is concerned, there is no TDS, but the tax is as like a fixed deposit. Okay, so let us say you are getting an interest income, you have to pay a tax on that, but there is no TDS. Unlike an FD, there is no TDS on GSEC. Okay, that is one difference. The other thing is, if you're buying and selling, you're subject to the normal capital gains. If you're selling it within 3 years, you are the short-term capital gain is applicable to you. If it is more than 3 years, you get indexation benefits and you have to pay the long-term capital gains.
Okay. Okay, so there's one anonymous attendee who is asking, are the returns assured? Kindly highlight historical returns data. I think this is a 6-month-old scheme, right? So
no. So government securities have been trading. So you're talking about governments. They have been trading for as long as I remember. So there the historical returns are available. So if you look at the historical returns, 10-year has gone as high as 13%. So a 1 year has gone as high as 10%. But right now we are in an age where interest rates are generally coming down globally. So today you are getting 640 for 1 year, which is as I told you, 150 basis points more than a fixed deposit. And for a 10-year today, you are getting 720. If you look at the fixed deposit, it is just 530, 535 or 510 or something. So you're earning at least 150, 160 basis points more than a fixed deposit. So that is a kind of returns. And this is once you lock into that, and if you're holding till maturity, you're assured of getting the same returns throughout. So there is nothing that changes in between.
Okay. So Celine wants to see a live demo of you working on the portal. Is that possible, Biju sir? You can just show it on the portal.
We can in case I'll just try to arrange that and Meanwhile, we can take the other questions.
So Velmurugan is asking, when we trade in secondary market with government bonds, why do we worry about liquidity? He's asking.
You have to worry about liquidity because you may not get a buyer, right? Suppose you want to sell it, right? So you may not actually get a buyer when you actually want it. So today you want to exit, and you want money, you may not be able to exit today. It may take 5 days for you to exit. So that is the liquidity risk we are talking about. I just try to log into that Retail Direct portal. Just give me some time.
So there's one more question by Sanjeevan. So he wants to understand if there are any plans to introduce interest rate derivatives in this scheme, simple futures or options.
So right now, interest rate derivatives are permitted. So if you are talking about so there is an interest rate future which is available on the exchange. Interest rate derivatives on the OTC market is mostly for institutions. Okay, so you have banks, mutual funds, and the lot size there is 25 crores and everything. So there is a market on the OTC side. On the exchange side, for the retail investors, there is an interest rate futures market. So if you're interested in trading interest rate derivatives, the IRF market would be the right market for you. On the OTC side, it's presently an institutional market, and the lot sizes are huge and those kind of things. RBI has also permitted interest rate options in terms of caps and floors and everything. That market has not yet picked up. The interest rate swap market is very liquid in the OTC market. So you have about 30,000-40,000 crores of swaps happening every day. But that again is typically institutional because the ticket sizes are huge there. Yeah, so this is the website. Okay, so you just go to rbi.retaildirect.org.in, and when you click here, you get all the yields as of yesterday evening. So 10-year is at 790, now 15 years. So this is one information that you get. Okay, and then you have to open a retail direct account. You just go here, and then it's a self explanatory guide where you can actually open an account, and all the instructions are available to you, and you can just go and register and open an account. Okay, so there is one option. So this is how you can register: name, PAN, email, mobile, date of birth, and your user ID and password that is you want, and you can just submit and register it. In case you have a CERSAI account, I mean CKYC, your data is already registered by your bank with the central KYC register, then it's very easy. Then the next steps are very easy. You just directly get to do the bank verification and open an account. In case it is not there, as I told you, you have to do a video KYC, which takes about 2 minutes. So our agents are available here between 10 to 6, and anytime you can call and just finish the video KYC part of it. So that is how, as I told you, it takes about just 5 to 10 minutes. If you are CERSAI compliant, if you are non CKYC this thing, then it takes about 12 to 15 minutes to open an account, and you get your login credentials by the next day, and you can start doing this. So I will just log into my account. So so this is the primary portal. So it's available on this part of it. And in terms of security, it's all OTP enabled. So you can now log in through using your email, mobile number, or the login ID that you have created, and you have a password. In addition to that, you also have a I hope we have the time to do this, right? No issues, right, on the time part?
Yes, sir, we have time.
So this is how the portal looks like. So you have the auctions which have been already announced by RBI available on the auction watch. So you have a central government auction, state government auction, T-bill and sovereign gold bond. So as and when RBI announces it, it is available here. You also get a mail alert about the auctions that are available. So currently you have a 2062, which is a 40-year paper which is available. Then a 7-year paper which is available, a 10-year paper and a 2-year paper. So this is the 4 papers. The details are there available in terms of the amount and the indicative. This is what is more important to you because this is what you will essentially get. So today, the indicative yield yesterday was 736. The actual cutoff that has come today in the auction was 740. Okay, so this is how you will take a decision whether to bid or not, and all the other details. What is the start time? You normally get about 2 to 3 or maybe even more than that, maybe 4 days to place your bid, and it is available 24/7. The funding option is also 24/7. The allotment date, the settlement date, all other details are given to you. Okay. So you choose a security, you just click on place bid, the bidding window is closed. So I don't know. Okay, the treasury bill is currently open. No. So right now, these 4 auctions, I think already the auctions have been closed. I think today evening, RBI will announce a treasury bill auction, which will be available. So essentially what you do is, you just click on this bid button and this gets populated at the downside. You just put in the amount, starting from 10,000 to whatever your bank allows you in terms of debits. So 5 lakh, 10 lakh, maybe you can go there and just click on submit. Once you click on submit, you get a pre-confirmation about the funding part of it. And when you say that you want to fund now, you will be taken to the UPI portal, and you can actually UPI or net banking, you can actually do a funding, and that's it. And the details then will be available in my bids till it is allotted. So let us say typically I will show you the I will tell you the workflow. So the Friday evening RBI announces a central government auction. So let's say they announce 4 auctions. So the auction is available to you for bidding by Friday 8 o'clock, 8:30. Now there is say today we take the case today. So by today 8:30 you will be able to see the auctions, and from today till Wednesday you will be able to place the bids if you are using net banking. Okay, because net banking is 1 day earlier, and if you are using UPI, you want to fund through UPI, the bidding window is from today 8:30 till Thursday 11:30 night. Okay, so you can place your bids, you can fund it using net banking or UPI. On Friday the auction happens, the cutoff gets announced, and the allotment will happen, and you will get your securities on Friday. That is how it is. That is how the entire cycle. So you get 3-4 days to decide, log in, and then do the bidding part of it. You can modify your bid within those 4 days. You can actually modify your bid, or you want to put more amount, or you want to withdraw, you want to cancel the bids. All those things you can do it, and all your actions are available to you in terms of activity log. And then when you come to your investor services, you also get your holdings. So this is your holdings, whatever investments you have made. Okay, your coupons that are due to you are seen here. The redemptions that will come to you are seen here. And you can make a service request of gift and all those things. So that is how it will be. So this is it. So basically you just click on the bid button, put the amount and do a submit. The amount that is shown to you, you have to fund it using net banking and UPI, and that's it. On Friday, you will get all the alerts saying that it is allotted and it's credited to your account and all those things. And you have to just log in again and check your investor services for the holding, which means it is there. And then the coupon and redemption automatically starts happening. You are actually holding the security with Reserve Bank of India, and it's bankruptcy remote. So nothing can go wrong. In case you want to apply for a secondary market account, then you have to click on this NDS Home link. This is the secondary market platform. So once you click on that, we get your request for a secondary market this thing. So out of these 1 lakh investors that I am talking about, not everybody goes for secondary market. People just want to just lock into a rate and just keep quiet. So they don't actually go for the secondary market. There are some 25-30% go for secondary market. You can raise your request, and the next day you will get your NDS Home login also, and then you can log into the NDS Home account and start trading on that part of it. So I mean, this is how you in case, and if you go here, there are videos which are available on the site, on the Retail Direct website. I will just show that to you. So if you go to the tour part of it, all the details are available. So
Welcome to RBI Retail Direct.
Yeah. So The introduction is there, the bond types of GSEC, pricing of GSEC, yield curves, then all the thing in terms of how to do the KYC, how to log in, how to bid, how to fund, how to amend, withdraw, allotment, everything is available in terms of a video. You just have, it's all a 2-minute video. Every video is about 2 minutes. You can just go through the videos.
In this video, we will show you how to fund a bid.
So everything is given to you. So that way you
Log
can
in
just
by
go through these
entering
videos.
your username and password. Now click on the primary market button and stay on this page. You can fund a bid in 2 ways. First method, you can fund immediately after placing the bid by clicking on the Now button of the funding alert that you will receive. In the second method, click on My Bids under Investor Activity. You will see a fund transfer option for each bid row. In both the methods, it will open up to the same funding screen. In the second method, when you click on My Bids, you will be able to see all the details of the bid. To fund a bid, click on the rupee symbol. This will open the funding screen with details of the amount to be funded. You can make the payment in 3 different ways. First, by way of net banking. Select your payment gateway bank, accept the terms and conditions and click on the Pay button. This will redirect you to the net banking page of your bank registered with RBI RD system. Log in with your net banking credentials to fund your bid. The second method is to UPI transfer. Select your payment gateway and enter your UPI ID. Accept the terms and conditions and click on the Pay button. Approve the payment request from your bank registered with Retail Direct. The third and final payment method is UPI transfer. Select your payment gateway and enter your UPI ID.
So, I mean, this is how you do it. You can go through the videos. I mean, in case, people are interested in that. And you can also, we have a toll-free number. We have a support mail also in case, you can write to us. We will help you in whatever queries you have on that.
So, sir, there's one last question before we close. So, what was the motivation for RBI to, go the direct way and not via the brokerages?
Yeah, so that is it was not a motivation. It was more of a so-called, what is it? They were forced to do this. So, essentially, as I told you, they tried through the broking route. It was tried in 2003 to do retail. So, brokering is costly. So, if you're going through a broker, for every 10,000 rupees that you invest, you have to pay 60 rupees. So, that's a commission that they charge. So, that was costly. And as you know, brokers, I would say there are more exciting markets than a government security. So, marketing a government security is not so attractive for a broker. That is one option that is there. Second was they tried to the banking channel also. So for a bank, I mean, banks, the retail customer base is huge. So if you can actually put this government bonds through a banking channel, but banks, as I told you, it competes with their fixed deposits. So they are also not interested in selling this. So then the only way to get, and RBI could sense that there is frustrations among the investors that they are getting low yields in a fixed deposit. I mean, they are just held to ransom by a bank, or because it's like a cartel. I mean, everybody gives you 5 and everybody gives you 5 and for 10. Nobody tries to break that this thing. So then this was the only thing that had to happen. So I mean, so if you say the 2003 and 2019 when the scheme was actually designed, so RBI did give you an opportunity for other intermediaries to pick up this market, but then since nobody was coming up, RBI had to do it directly.
So basically, just to conclude with one last question. One of the viewers was asking, why not do it through banks as well? Because many senior citizens would not be able to move around using a website. Mm-hmm. So why not use the banking channel as well? Mm-hmm. To get this to the general masses.
We would be very happy if banks actually want to do. We would be very happy if actually banks are interested in joining us. We can actually give them a lot of technological solutions to connect to the portal. I mean, we are open to it. Our understanding is that right now banks may not be so much interested. Maybe we can always explore any partnership with any bank. I mean, even if one bank's come forward and we are able to connect to that bank through the CBS or and our portal, we would be more than happy to do it. I mean, we are open to that.
Sure. Okay. Yeah. Yeah. Thank you so much, Biju sir, for accepting our invitation and doing this. Very, very helpful. Thank you. Thank you very much. Yeah.
Thanks, and thanks you all for giving us this opportunity. CCIL and CCL, from CCL's perspective also, this is a good platform to just connect with the retail. Thanks, sir.
Sure. Yeah.
Open.